So the question is from Fernhurst Co. And as I go through, I'm going to also be taking you through some of those best like things that you have to do so that you are able to do the questions in the exam very well. So, for example, one of the things that you need to realize is that when you have a question like this, as opposed to first looking at the scenario, you do need to first go and look at the required before you can come back and look at the scenario itself. So if we do that and we go to the required, we see that we have been given a question of 25 marks. So this is a section B question. You know that AFM papers, just like any other papers that you find on level 3, have section A, have section B. Section A question, you have one question of 50 marks, which is half of the exam, and then you have 2 questions from section B. So this is the section B question, and usually it has 20 marks for calculation and discussion and all that, and then it has 5 marks professional skills. Of course, professional skills, you have seen some of them maybe in other papers that you've done on level 3, but if you haven't done any papers of level 3, basically they are asking for commercial acumen, skepticism, analysis and evaluation, communication, and the like. So you can find those on the website for ACCA where they talk about the professional skills. So I'm just going to show you how to get them as you do a question, because in the exam you do have 20 marks. You do have 20 marks. So in the exam, you do have 20 marks for professional skills, whereby 10 of them are in section A and 10 in section B. So if you don't get those marks, it's very likely that you have not passed the exam. Okay, because there is no way you can get the 80 marks when you have not got these 20 marks, as we shall see how these marks are got. The chances are, if you fail to get those 20 marks, okay, not exactly all the 20 marks, because you can get 15, you can get 10 and still pass. But if you don't score at least 10 of those marks, that means that something has gone terribly wrong. So what are they asking us here? Financial acceptability of the investment in Midland, and calculate and comment on the investment's duration. So we shall see what they mean by that, but what you need to understand is the duration. In this case, this is one of those new concepts in AFM that are not there in the normal paper, financial management. So perhaps if you are coming from financial management and you know how to do NPV computations, this would be the only thing that should worry you at this question. But we shall see what investment duration means. And then they want to also discuss the non-executive director's understanding of net present value and explain the importance of other measures in providing data about an investment short and long-term performance. And we shall see how that also can be handled. Of course, they are saying their marks are variable for analysis and evaluation, skepticism, commercial acumen. So analysis and evaluation basically means, can you read the scenario and pick the key information that is given to you and use it to answer the questions asked. And usually that is going to involve picking figures, calculating. So usually whenever you calculate, you are looking at analysis and evaluation, but also the calculation usually has a decision that comes with it where you normally say invest or not, and that is the analysis part of it, because just looking at evaluation can just mean calculate NPV, but analysis in this case usually comes with what insights have you got from that figure. As I told you, you are going to get a big understanding of this if you read through the article which talks about them, or when you go to the textbook, in the first pages they discuss these concepts. Skepticism is questioning what has been given to you, the facts. Like, for example, the director can say, we are so confident that we are going to get 20% return on investment. And then you now come and say, okay, 20% return on investment, but the industry is getting only 15 or 10. How are you going to beat the industry by 10 percentage points? So you are questioning the facts. That's where you put some assumptions that have been made, and you also talk about whether those assumptions are realistic or not, things like that. And commercial acumen is basically knowledge of business of the company that you are dealing with. It's business knowledge. So usually as you're advising, also as you are giving some of the recommendations, that is going to come into there. And also use of some of the techniques that you're already using for calculation. So most cases, when you are doing calculations and answering this question correctly, you will get these 5 marks without a hiccup. You just have to make sure you are not losing sight of them. Like if they want you to analyze, already that's going to be done here. But skepticism, you may forget to question something, and then commercial acumen. So make sure that you don't lose sight of those marks. But as you're writing your answer, they'll come through. So we shall see other examples, of course, as we do other questions, how those marks come. But having looked at the questions, we can now go and now look at the scenario. So they're saying that Fernhurst is a manufacturer of mobile communications technology, about to launch a new communications device, the Mirand. Directors believe it is both more technologically advanced and easier to use than devices currently offered by the rivals. That's where we start from. Of course, if you're going to answer this question, you know that everything they give you might be important, and therefore, when you are, now that we saw the question, we see that this might also come in handy as we go. But of course, we can proceed. So now they want to invest in this Mirand. It requires a major investment in facilities. Directors believe that this can take place very quickly and production begin almost immediately. Now, this is one of the first places where you can say, really? Because you know, if you are going to be setting up a plant, it's going to take you some time before that plant is actually operational. So it's not going to be something that is likely that you can start immediately and you start making sales, unless you are going to just buy a factory which is already in place. So they are going to sell 1,500 units in the first year, and sales volume is going to increase by 20% in year 2, 30% in year 3, then be the same in year 4 as year 3. And then as the product reaches the end of its useful life. Even this, okay, this is an assumption that they're making of the sales growth. It may not actually pan out to be the case. Then they have been given variable cost of the units going to be 43.68 in year 1, rises by inflation subsequent years. Fixed costs are going to be 900,000 in year 1, rising by inflation in other years. So in this case, they are telling us inflation, but they are giving us the figure for year 1 already inflated. Okay, there is a situation where you're going to see sometimes they give you information where they say the figure is going to be 43.68, but in current terms. Okay, we shall see that inflation, when you talk about it, you talk about nominal value or real value. Okay, and current terms means they are just giving it you in the money terms, nominal value. So when you are going to use it, you have to make sure that if everything else is being inflated, you should also inflate it. And there are different ways of dealing with that, which, as we said, things we already know from financial management. In case you don't remember them, you can always get a quick look in the textbook or the pocket notes to get to speed. Then they are going to invest 16 million initially in non-current assets. Then they make immediate investment of 1.025 million in working capital. So, and they will increase it annually at the start of each year by the inflation rate, and it's fully recoverable at the end of the project's life. So that is it with the working capital. Then we shall incur one-off marketing expenditure of 1.5 post-inflation. So this one has already been inflated after the launch of the Midland. And they are going to incur that at the end of year one, and it's tax allowable. Then from there, the tax that Fernhurst pays is 25%. It's payable in the year that the tax liability arises. Depreciation is 20% on investment in non-current assets on a reducing balance basis. And the balancing adjustment will be available in year 4. So, realizable value of the investment at the end of year 4 is expected to be 0. Then annual rate of inflation in Fernhurst is 4% in year 1, 5% in years 2 to 4. And the cost of capital is 11%. Now, this is a standard question about NPV. So they have given us other information. So the director has indicated that besides needing net present value, they also need to know the figure for the duration. Okay, so that's why we are going to calculate duration. And then also there's another information here given to us concerning assessment of new products. It says that the board meeting, the last one, discussed another possible new product, the Racton, and the financial director presented a range of financial data relating to this product. The results of NPV were brought, but also payback evaluation. And one of the directors, who is not a qualified accountant, stated that he found it difficult to see the significance of these other items. Okay, for him, he says that we just have to invest where there is a positive NPV, and shareholders should be okay. And now, the financial director commented that in reality, some shareholders looked at the performance of investments with Fernhurst over the short term, whereas others looked at the long term. So now, this sort in a way has the answer. The question and the answer are in there. You just have to know how to actually bring it up. But that's what we have. And of course, now we know what is required of us. We need to first have, determine whether the project is acceptable or not. So now, as I said, this is a typical net present value question, and this is how you would deal with such a question. So you would first of all do this from a spreadsheet. So remember, when you are doing this paper, you are going to be given a spreadsheet and a Word document. And you need to put the computations in a spreadsheet and then the discussions in the Word document. So what we are going to do is to put the years. And of course, year 0, 1, 2, 3, 4. Project is for 4 years. And then from there, you also have to see what accuracy are you going to go with. So you can work in thousands, because you see, usually what happens is that you look at the figures and then you can decide which figures you can round. But of course, I can actually first start with working in dollars. Okay, because having Excel means that you don't have to worry so much about whether you are working in dollars or whether you're working in shillings, or in thousands. So you can first work in, let's first work in actually dollars. So what we're going to need to first of all know, when you are setting up these kinds of questions, you normally have revenue, then you bring the costs, then after bringing the cost, then you bring tax, and then something like that. So revenue, they told us that we are going to sell 3,500 units. So means that we need the working. So working one is going to be revenue. So we are going to copy the years, borrow them. So we need to first of all get the units. So the units are going to be 132,500 in year one. Then they said that they will grow by 20% in year two. So this one grows by 20%, multiplied by 1.2 in year two. Then 30% in year three. That's 30% in year three. And then in year four, it will be the same as year three. So just make it equal to year three. So those are the units. Okay. So having our units, then we can now get the selling price. So they're going to sell at 100 in year one, but then it's going to grow by inflation annually. So selling price so in year one, 100. Okay. Then it's going to increase by inflation annually from year two onwards. And inflation from year two onwards is 5%. So that means that you can grow this one by 5%. Okay. Then you grow the same. And all those are the 4 years. So then now you can now have the revenue as the product of the selling price by the units. So which gives us those figures. So we have 13.25, 16.695, and so on. So that is going to be our revenue. So having gotten our revenue, then we go and see what comes next. So what comes next is basically variable costs. This is also working too. So you have your working too, variable costs. So we can still utilize the same years. And they say that the variable costs are going to be 43.68 in year one. So variable cost per unit, 43.68. And then they are going to grow. Let's see. Inflation. And inflation, we said it's 5%. So then you can drag this. Since they gave us decimal places, you can put two decimal places. Then you can now have variable costs, which is the product of the units and the variable cost per unit. Okay. So you can now come and bring them here as negatives because they are expenses. So having brought those ones, then we also see if we have some fixed costs. So fixed costs, 900,000 in year one. and then they rise by inflation. So they're going to grow by 5%. Okay, so I hope that is clear. We don't inflate here on figures because they told us that those are going to be expected to be. So they already gave us those figures in real terms when they have already been inflated. So this is where some of you make a mistake and inflate the figures that have already been inflated, or the other way around, when they don't tell you that they have been, they tell you that they're in current amounts, but you don't inflate them. So what you need to do is to just not cram it, but rather apply as the scenario is saying. So now after I have our fixed costs, what normally follows here is depreciation, if we have taxable depreciation. So we are going to need a working for it. Okay, so we have year one. What's the cost? So remember, they told us that depreciation is 20% reducing balance. And it's on the investment, non-current assets, which is 16 million. So the cost is 16 million. And then you subtract 20% depreciation. So which is 3.2. And the carry forward figure becomes 12.8. That's year one. Then for year two, you start from this 12.8 and remove another 20%. That's what reducing balance is all about. So when you remove another 20%, you're now at 10.24. Then you do the same thing for year three. Now, remember this project is for 4 years. So in year four, you look at the scrap. Now, the scrap is the residual value, but they say that the residual value is 0. So residual value is 0. Therefore, that means that this whole figure that you are carrying, you are going to give it as a balancing allowance. This becomes a balancing allowance. So that's what you are going to bring here as the depreciation. So in year one, 3.2. In year two, 2.5. Year three, 2.048. And finally in year four, 8.192. Now, I remember that there's another cost here, which they told us that marketing. And they told us that this marketing cost is going to be 1.5 at the end of year one. So now, so usually sometimes you find that the best way to do this is to have the marketing cost, like I'm just rearranging it a little bit, put the marketing cost up. It doesn't really affect your computation. I'm just showing how most people do it. The depreciation should come after all the costs are done. Okay, so after all the costs that are taxable, okay, let me clarify that they have to be taxable. We shall see that some of them come afterwards, like working capital. So you get the total for the figure, and what you get here is the taxable amount for taxable cash flow. Now, then you do tax. Now, for tax, you need to know the rate and when it's payable. So tax is payable in the same year, 25%. So which means that you're going to do 25% of the taxable cash flow. So that gives you the tax. Now, what you need to remember is that depreciation is not a cash flow. We just put it there so that we can tax. So we have to add it back right away after taxing. So after bringing it back, then you can now go and look at other cash flows that occur that do not have effects from tax. And we can see they have told us that initial investment is 16 million. So here we can put initial investment. Usually they start with working capital, which needs the working. So we are going to copy some of the years. Now, they say the working capital is 1.025. So working capital needed 1025 at the start. Okay. Then it's going to increase annually at the start of year 2 to 4 by the rate of inflation. So inflation for year 1 is 4%, which means that this is going to grow by 4%. Then it's now going to grow by 5% from year 2 onwards. And basically, you don't have to take it towards to the 4th year, because this is 1, 2, 3, 4. You need 4 years of working capital. It's just that we get them at the beginning of the years. So that is what is needed. What about the change? Because remember, when you put in the 1.025 at the beginning, you don't now put another 1.066. You just put in the difference, what you need to make it 1.066. So just add in 41,000, then you add in another 53,000, and then you add in another 55,000. And in the 4th year, everything is recovered. So you do minus sum of everything. So the whole of 1.175 becomes recovered at the end of the project. So that's what you are going to bring here. So you bring your working capital, 1.025. Then make sure that it adds up to 0 on that line. So after that, then you can now bring in the initial investment, which is 16 million. And if you also have been given the scrap, you put it here. I'm just putting 0 so that you know that you can put scrap. You can put the scrap on the same line or another line, doesn't matter. You have a choice where you put it. But basically after that, Then you have all your cash flows. Now you can add everything up together. And get your total cash flows. Now, after that, what follows depends on how you practice it. And I want you to practice doing the simple one. But there are two or three ways of doing this. So the first way would be to get a discount factor. And the discount factor, they told us that we are going to use 11%. Now, when you are given 11%, then you can actually get to the tables and get 11 discount factors. So let me just get the tables. So the tables are given to you in the exam as part of the formula sheet. So that's what I've been pulling out. So now the tables are given to you here. So you can, now we are doing present value, so you can just come to this present value table. 11% is here. Then you can pick figures. Okay, 0.901. So the first one at year 0 is 1. Okay, then year 1, 0.901. Then you go 0.812. Then you go 0.731. And finally 0.659. So you can do that. Get from the tables. Okay. However, on the same tables app, there is a formula for finding the present value, 1 plus r power minus n. And that one saves you by just coming here and you just say equals 1 plus 11% power minus n. And you just basically drag the formula and you have the same exact answers. But you realize that this has been faster, much, much faster. So because this is much, much faster, and it also saves you from making a mistake of probably copying the wrong values as you're copying from the table, I prefer you do that. So from there, you now can get present value by basically multiplying the discount factor by total cash flow. And then you drag everything, then you get net present value as the sum of our present values. So you can do it that way. And if, so you say since NPV is positive, we accept the project. Because this is what normally happens. When NPV is positive, we accept the project. Okay, this is another way of doing it, but there is a better way of doing this using a formula that is not given to you in the formula sheet, but it's there in the Excel spreadsheet that you use in the exam. So the examiner likes that you save time, and you also would like to save time by using this method. It goes like this: NPV. Okay, you learn it from Excel, and then you also transfer it to the exam environment, as you should be going to the practice platform and practicing doing these things. Because here in Excel, it gives you basically what you need to give it, But in the exam environment, they don't give you any ideas of what you should put and shouldn't put. So which means that basically you need to have an idea, you need to know what the formula is and how to use. So here you put it, the rate is the first thing, you put 11%, put a comma. Now it wants you to give it the values. So the values that it wants are values starting from year 1. Okay. If you go to Excel, it can tell you future payments and income. And then the values, it starts in time occurring at the end of each period, starting from year 1. So NPV, give it a rate, now give it the values, which means you give it total cash flows, but from year 1, and then you drag, give it all the years. Now, those years have to be continuous. So you have to have 0, 1, 2, 3, 4. You shouldn't be skipping any of those years, then the formula won't work. Now, when you do that, you now subtract the initial investment. Now, the initial investment being negative, I'm going to put plus, and I put it there like that. And I get the same exact answer. Okay? But this one saves me from having to do this. Okay? I just actually all of these, because instead of doing discount factors, present value, NPV, I just do it in one sweep. And the examiner will give you the same exact marks. So it is in your best interest that you actually do it this way, because you are looking for ways of actually saving time in the exam, not doing the most. Okay, you don't want to do the most, you just want to do the right thing, but in the fastest time period. So before we move on, is there any questions regarding this computation? Helen, is there any question? Okay.
No, there is no question.
Okay. So
Thank
that is the first part, which was basically asking us to calculate. And so it said, evaluate the financial acceptability. So basically, you calculate, but you have to say the project should be accepted, okay, since it is giving us a positive net present value. Now, second thing of that question was that we need to also calculate the investment duration. Now, in one of the challenges with having payback period, because now when you look at payback period as one of, this is sort of discussion from what we are going to discuss in the second part of this question, but one of the methods we can use for identifying acceptability of projects is called payback period. But the payback period just looks at how long does it take for you to recover your initial investment. But there are two problems with it. One is that it does not take into consideration the time value of money. That's one. But also, it does not, or you say it only considers up to when, or you can say it does not consider the entire life of the project. Only up to the point when the costs are recovered. So that is basically the problem with payback period. And what do you do to remedy this? You can do what we call the discounted payback period. But this one is going to have the first problem solved, but the second one won't be solved. Still does not consider the entire life of the project. So what then can you do? That's where we have what we call ultimate solution. We use duration. So duration is a new concept in advanced financial management, meaning that it was not there in the FM days. Therefore, you may not know how to calculate it. So once you find yourself in such a situation, you can always go to the textbook and you find duration. Okay, and duration is also called Macaulay duration. And here they explain to you what duration is. Okay, in case you don't know about it, it looks at the time to recover the present value of the project, but it looks at discounted cash flow, and also if you're discounting at cost of capital. So it looks at both the time value of money and also the whole of the cash flows of a project. These are the two issues that were, which I mentioned to you, were issues with payback period. So it can be used across projects to indicate when approximately half of the project value will be captured, and the project has a higher duration, then there is more risk than when we have lower duration. So this is basically what you need. And now, how do you calculate the duration? They explain to you here, and they go into the story of payback period and all those things that I've explained to you. And of course, there's an example. So when you go there, you understand basically what to do. But let us do it here now. So for you to work with duration, basically what you need is the cash flows from year one. Okay, from year one to the end of the project. So you have, let me just get year one to year four. Then you bring the present value of those cash flows. So now this is where you would maybe need to do present value this way here, because I want to get the present values. And if you use this formula, you now have to calculate them, which is still okay, doesn't hurt. But these are the present value of the cash flows from year one to year four. Then what you do, you calculate. So here I can put total. So the total of these present values is 24.822. So what I can do is to get the percentage of the present value. Basically, I want to know. Okay, so I realized I had lost you. I don't know where I had lost you. Just give me a second. Let me first come. Okay, so uh, let me just repeat a little bit because I lost you and I don't know where I lost. So what I've done so far is to bring the present values, okay, for each of these 4 years. Then from there, you can get the proportion, or you can just get present value multiplied by the years. Basically, what you do 4.101 times 1. Then you do the same for all of them, okay? And then you still get the sum for those. So now what you need to do to get duration, you basically get this product of present value and years divided by the sum of the present values, which gives you 3 or 2.78 years. Now, this is the duration. Okay, as I said, this is something that is new for AFM. It's not something we've done before in level 2. So in case it's not clear, you can always look at that example I just showed you, and then you can just search duration in the kit and you'd find all places where the calculations of a sort are being done, and you practice. But basically what this means is that it takes on average 2.78 years for us to get back half of our NPV. Now, on its own, it may not be a problem, but if you have other projects that have a higher duration, then this is a good project. But if you find that other projects' durations are lower, then you may want to do the ones with lower duration, because shareholders are looking at both long-term and short-term, like the statement said. And how do they do so? By making sure that when they are looking at the short-term, they are seeing how fast can they get their money back. And when they are looking at the long-term, they are seeing what's the total addition to their wealth that's going to come after that investment. So ideally, both of those investments are important for the shareholder, because the shareholder wants to basically get the best of both worlds, to have some short-term investments and also long-term investments, so that the short-term investments keep him liquid, but the long-term investments usually have better return. Okay, is that clear? Is there any question on that point?
I'm wondering, do
Yes.
you then put it as 2.78 years, or you round it off to 3?
No, you don't round off to 3.
You leave it as is.
Yes, because ideally what you want to do, in fact, I can also say that this is 2 years, and I can now determine how many months by saying 0.78 times 12, which gives me something like about 9 months. Okay, so 2 years, 9 months. So if you round off, then you lose this accuracy.
Okay.
Yeah. Now, just to also illustrate something, because ideally, this question was just about NPV and then duration, and then the second part. But just to illustrate, the other thing that we can do with this is find the internal rate of return. So internal rate of return, and also modify internal rate of return. Okay. Yes. So these are also two things that we can get, and also when you got the textbook, because this chapter is the one where we have these kinds of questions. So we have all sorts of things that we are dealing with here. We have done duration, discounted payback period is also there. But these are from those earlier days of FM. So I suspect that you know them. But there are other things like this MIR that you haven't. That's also new, something new in AFM, and also internal rate of return. We know it, but I'm just going to complete these two, just as a way of basically getting more practice on this. But I would suggest, if you find you don't have some clarity on this, is to go to this textbook and first pick the examples and test your understanding and try to do them. See, and you check the answers and see whether you have some issues, then you read about it there. So let us do internal rate of return. So internal rate of return requires us to have the formula. And I'm going to show you two things. I'm going to first show you this formula. And then I'm going to show you the one that is in Excel. So we just copy this, take it to our Excel file. So this is a formula for internal rate of return. And it requires us to have basically two rates, okay? A rate which is lower and a higher rate. Then get NPV at the lower and NPV at the higher rate. Then we just calculate it like this. So, for example, since this NPV of 11% gives us a positive, it stands the reason that NPV of maybe 15% or even higher might give us a negative. Now, since I have a formula that works very well, the one I just showed you before, I'm going to just do NPV and just let me illustrate it at 10%. So I just go again and say NPV 10%, give it the cash flows from year one. Okay. And then subtract initial investment. So that is how you'd get NPV at 10% very fast. Now, I can also do it at 20%. Or let us try 15%. You don't want to have a very big gap. So I normally try 10 and 15. So the cash flows from year one, subtract initial investment. So you can see that this formula can give us NPV very fast. And in fact, if I'm using this formula, I can afford to say, okay, I want to get internal rate of return, and I know it's between positive and negative, and these both are giving me positive. Let me get another one. Okay, and I'm going to show you how to, even with these ones, I can get the answer without putting another one. Okay, but since I already have this formula, which is very easy, I'm just going to come here and change this thing to 15%. And then make this one 20% because I can. Okay, but if you are going to do so much, then you would just use the ones we have here. And even here, I say I'm still at positive, but I'm coming close. So, but just for the sake of it, let me now do 20 and 25. Now let's this one make it 25%. And I'm still at positive. But at this point, let me just first find what the IR is, then we can see where it lies. So how do you get internal rate of return? It says you start from the lower rate, which in this case is going to be 20% plus NPV of the lower rate, which is this one, divided by NPV of the lower rate minus NPV of the higher rate, then multiply by the difference between the higher and lower rate, 25% minus 20%. And you see that the answer that I'm getting is 27%. 0.4%. So this is the end, this is the internal rate of return. Now, if I change this one to 25 and this one 30, I'm going to get very close to this one because now I know where it is. Okay, but what I want to tell you is that in the exam, you don't have to get two figures that are so close to that positive and negative to get the answer. Although being that we are extrapolating or interpolating, in this case we are extrapolating because the answer is outside the range, it is very nice if the figures are close. So, but as well, if you get 27% from this one, you got to get your marks, explain it, get everything right. But let's say that we had this as 25%. And this one 30%. Now you see that I have a positive and a negative. Now when I come here and I start from 25%, and here I have 30% minus 25%. Now I get 27.8. I think it's similar, if not the same that I had before.
That's what we had before.
Okay. So you see that this did not change so much with our computation. So this is our internal rate of return. But I can also get internal rate of return using a formula. And this formula also works when the years are in sequence, okay? Like you have 0, 1, 2, 3, up to 5, or whatever, but there's no gaps missing. And if you know it, all you have to do is to say is equal to internal rate of return. Then you give it the values, and the values are the cash flows. And this time you start from 0, like that. And you see that what you get is 27.7. Okay? Only one move and I've got the answer. So this is the value of having these formulas. And these formulas are there in the Excel spreadsheet in the exam, but they don't give you a lot of indication of how to use them, which means that you have to go in when you know them. So practicing them is very paramount because it's going to save you a lot of time. Now, I can use both of these methods because these years are continuous, like I said. But if you don't have those years being continuous, you need to use this one. That's why you need to know this formula as well, because most cases you find yourself not able to use this one here because you are dealing with annuities or something of a sort. And therefore, you can't say they brought the other around. I was only ready for this. You have to be ready for the both of them. So that is basically internal rate of return. And for it, we normally compare it with the cost of capital. So if the cost of capital is lower than internal rate of return, then accept the project. Okay, so and ideally, since the project already is acceptable by NPV, if you get that this one doesn't accept it, then there's something wrong with IRR. And that is not something that is not common. IRR can give you one internal rate of return, can give you 2, or can give you none. Because it is actually not a linear equation. So if you read through the notes, you will see why it is not very trustworthy in some situations and others it is. So that's why NPV is the most trusted in terms of coming up to deciding whether to go with the project or not. But now there is what we call MIR, as I showed you in the notes. So if we go to the notes and see what they talk about it, this is where they talk about IRR, and the formula is given to you. and examples which you can use, and they are telling you that there is a function in the CBE. How do you interpret it? All these things that we know from before. And then they give you why sometimes it is not trustworthy, and therefore why they use MIRR. Okay. So this one is given to you in the formula sheet. If we got the formula sheet, okay, it is here. Modified internal rate of return. So it's given to you. What you need to know about these formulas is that they don't give you what the terms mean and how to use them. So you need to know how to use the formulas, but you can just find them. So what you should do as a way of practicing is basically looking at what formulas are here and how can you use them. Okay, so that when you go to the exam, you know each and every one of these formulas and where you're going to find it useful. So here we are using this one, and it has present value of the return phase, present value of the investment phase, 1 over n, 1 plus RE minus 1. So when you look at the present value figures that we got, these ones, if we copy them, just put them here close by. So those are our those are our present values, and I can put in the years just to know that these are for years 0, 1, 2, 3, 4. Now the return phase is the one which starts from year 1 to year 4, and this is the investment phase. So present value of the return phase is basically the sum of these ones. Okay, the one starting from year 1 to year 4. The present value of the investment phase is basically this 17.025. Then N is 4 years, and RE is the cost of capital, which is 11%. And then you have the formula here. Okay. So present value of the return phase over present value investment phase. Let me just take this one to our Excel. Okay. So you can do our MIR. It's going to be present value of the return phase divided by present value of the investment phase, power 1 over n multiplied by 1 plus RE minus 1. And it also gives us a percentage, okay, 22%. And it's the same decision that we make. If the cost of capital is greater, or actually less than this MIR, we accept the project. Otherwise, reject. Now, what does this have over the internal rate of return is that it's always going to be one figure. Okay, I've not read through these parts here, but as I showed you where they are, like you can go and read them by yourself, but I can just highlight that the decision is not always clear for IRR because it can have 2 of them or more, or it can have none. and it becomes difficult to choose which one should you use for choosing whether to accept or not. Okay, where they can have multiple IRRs. That's the major problem. But it also assumes that we are going to reinvest at the internal rate of return, which is not true. Most people reinvest at the cost of capital. So these issues, both of them are solved, or the three of them, because really they are two, if you think about it, but they are all solved by this MIRR. So it's going to give you an assumption that you are reinvesting at the cost of capital, but also it will only give you one value, which means that you can always rely on it to make a decision on whether to invest or not. So that was not part of this question, but I figured because we are using this question to summarize what is covered there, I figured I should also look at it. And of course, you can also go ahead and look at present payback period and discounted payback period from the textbook, just for completeness of this chapter. Now, I think we can now go and look at the second part of this, which we have basically looked at in a way, because the figures that they wanted us to look at was net present value and payback. And they were saying, discuss the understanding of NPV that the director has, and explain the importance of other measures. Okay, so here you would say, of course, the director is correct about the NPV assumption, because he said when the NPV is positive, it adds value to the shareholders and they will be happy. Yes, that is correct. However, net present value does not give you an idea of whether that money the project is going to be recovered in the short run or in the long run. So the number doesn't tell you, because it tells you that this project is going to be profitable on the overall. But it doesn't tell you how long does it take for you to get your project to pay back. And if you are interested in the long run, that may not be a problem. But some directors or some shareholders, as we said, like for example, you can invest your money, but you just want to have that money come back fast. Maybe that's your livelihood, that's your income. So for them, they may want the project to be paying back in a short while, which means that to them, it matters not only if the project is profitable, but if does it pay back fast. That's why a payback period now comes into play. Okay, so basically you are now discussing the short-term and long-term performance, and also why NPV may not help you with that. Okay, so what you usually do with these questions after you attempt them is that the examiner, when they give you the solution, they write quite a lot because they want you to use it as a learning tool. And I also want you to do the same. But when you are in the exam writing, please don't write a lot. Make sure that when you're writing, the points that you need are hit, and each point should have a paragraph of its own so that the person marking can easily see them. Okay. If I take you to the solution to this, you see what not to do. So let's go to the solution to this. So of course, when you go to this one, you just check it, but this is okay. Net present value positive, all those things, the workings, that's okay. Duration is completed here. Now, you see this, okay? The second part, they have written a lot, okay? In the exam, you can't have time to write this much because you are rushing to go do another question. And each minute you spend more on this one are the marks that you are not getting from the other question. So normally you should have it that ideally you have at least 1 mark or 2 per point, usually. So when the question is for 5 marks, that means that you can make 3 nice points and you get 5 marks, as opposed to making 5 weak points, because you may fail to get the marks. Now here, like I said, they told us that the shareholders' wealth will be increased, and we say that is correct. However, it has to be modified if the company wants to take different investments and capital is rationed. So it's not just about the highest NPV, but also they have to look at how much they're investing and also the duration. Okay, so that's a good point to make. So, and here they say it's not just about the long term. So they also have short-term indicators, and for example, they may want dividends. And that means that by doing so, that's where a payback period can come in. Also, the risk can affect their views. So they may want to have most of their returns in the short run, such that they don't have to sit down with the risk of what if 5 years later the money doesn't come. Okay, then they show you that payback solves those issues that you have highlighted above. All the points that are made here are very legitimately correct. The point is to see a way of making sure that the lines, you reduce a little bit on the size of the paragraph. And this one is a nice one because they put the points in paragraphs. There are some where you find there is a block thing and everything is in that one block thing. That's the wrong way to do it. This is correct. Just try to summarize it so that you don't have to write a lot. Also, given that the exam is typed on either a spreadsheet or a Word document, having speed at typing can help with that. I don't know how fast you are when it comes to typing, but if you are not, then you should be practicing how to increase your speed. Okay, so now when you go to this last part of the answer, they explain to you what these professional skills are. Okay, so, and you can see here, analysis, as we said, use the data to determine stable calculations. Then you support discussion using the data and you draw conclusions. That is analysis and evaluation. Then skepticism, challenging information, evidence, and assumptions supplied, looking at everything. And here, recommending practical and plausible answers in this situation of Fernhurst. Things like examples or calculations from the scenario that can help to give a recommendation that makes sense. So those are some of the ways you can get these marks. And as I said, there is a lot that is talked about them. In fact, when you go to the kit and you search for professional marks or professional skills, you will find that, okay, I think this one, we came to another summary at the end of the paper for professional skills, but there is a professional skills section. Maybe it is in here in the notes. Yes. So there's a whole chapter here explaining professional skills. So when you got that chapter, you will basically understand more of what they expect you for each of those different skills. So communication and the like. So I don't know if you have any questions for me at the moment.
No, I don't.
Okay, so I have shared with you this link for Classroom. I have shared it in the chat here and even in WhatsApp. What I want you to do is to click on it, takes you to the Classroom, you register with your Gmail, and you get access. Because that's where I normally put the materials. And so because I want you to watch the 2 videos that for the previous ones, and then also the others that I subsequently keep adding will be in that Classroom. And what I'm also planning to do is to put all the lessons at once there, so that in case, because given that we study, being adults, we have different times of studying and all. So you may find that you have some days where you have enough like gas to do more than one lesson, as opposed to me throwing there one lesson at a time. So that should speed up things. So I'm going to do
So
that.
will they be pre-recorded?
Yes. And then, of course, we have these ones that we'll be having here where we do the questions. Because, the way we said we are doing, like the videos that I shared last time, they are explaining the scenarios and some questions attempted, and then we come and do a question together here. So that's the idea of doing it. So that when you have time, can move faster. Then also, by the time we come to the class, you have watched the video where we are going to answer these questions from, so that we move a little bit faster. Okay, so click on that link so that I'll keep checking to see whether you have logged in and become one of the students in the class, and then we shall keep on putting information there as we get it.
Okay.
Yeah. Okay, so thank you. Have a good evening, and I'll now share this recording plus the videos for next week. Have a good night.
Okay then. Good night. Thank you for the evening.
Welcome.